In March 2026, Brent crude oil prices surged by 80% in just weeks, eventually reaching $117 per barrel. While the global economy prepares for a major downturn, India's domestic output remains an outlier. It currently holds the top global ranking in manufacturing and service PMI indices. This growth is visible in the physical economy. Two-wheeler sales jumped 35%, while tractor sales, a key indicator of rural momentum, grew 34%. That momentum is mirrored in logistics. Air cargo volume has accelerated by 18%, and GST e-way bills have risen by 19%, indicating a continuous movement of goods. But there is a ceiling on this expansion. Despite internal strength, India's merchandise trade deficit has widened to $311 billion. The primary cause is the regional war involving the US, Israel, and Iran, which has physically severed the Strait of Hormuz. The shock originating at this choke point travels through refining margins and appears as a direct cost on India's currency and trade balance. India's immediate future depends on the outcome of a race: robust domestic consumption versus the mounting geopolitical tax imposed by the closure of Middle Eastern energy routes. This map shows the volume at stake. Every day, 20.9 million barrels of oil pass through the Strait of Hormuz, representing 32% of all seaborne crude. Since the outbreak of war, shipping traffic has declined by 90%. Daily transits have fallen from an average of 140 ships to fewer than 5. Pipeline alternatives cannot replace this volume. Total bypass capacity through Saudi Arabia and the UAE is physically capped at roughly 2.6 million barrels per day. This bottleneck is a specific threat to the east. 84% of the crude and 83% of the LNG passing through the strait is destined for Asian markets. Kuwait faces the highest risk in the region, possessing no alternative export routes for its oil production. This crisis is systemic because the infrastructure required to move this energy is suffering physical damage. Strikes against Qatar's Ras Laffan hub have already resulted in a 17% loss in the country's LNG capacity, removing 3 to 5% of the global supply. Because specialized export hubs require 3 to 5 years of repair work, the global energy market is facing a systemic supply deficit. In Iran, damage to the South Pars field, the world's largest gas field, is disrupting domestic supply and halting exports to Iraq. Regional gas processing has tightened further following the shutdown of the Habshan plant in the UAE due to strike debris. While Saudi Arabia's Ras Tanura refinery is expected to restart within 2 weeks, its safety shutdown caused an immediate export disruption. The math is absolute. The energy Asian markets depend on has stopped moving, and the infrastructure to restart those flows is severely compromised. This severe crude scarcity is reconfiguring the economic logic of oil refining. A refinery's profit is determined by its crack spread, the difference between the price of crude oil and the refined products it creates, such as diesel and petrol. These margins have decoupled violently. Diesel and jet fuel cracks have spiked to $55 and $60 per barrel, roughly triple their recent averages. Conversely, the margin for petrol has collapsed to negative $1.8 per barrel. Global tightness in fuel for heavy industry and military logistics is pushing diesel prices up, while high prices are simultaneously destroying consumer demand for petrol. Refiners are now chasing high diesel margins. However, since gasoline is a natural byproduct of that process, this has created a surplus of petrol that the market no longer wants. This favors refiners configured for middle distillates, while penalizing those that produce higher percentages of gasoline. These shifts serve as an immediate price signal for global commerce, effectively prioritizing industrial fuel over consumer use. For India, this means a steep increase in the overhead for freight, rail, and heavy logistics. The conflict hasn't just increased the cost of crude, it has placed a specific tax on the industrial fuels that drive the manufacturing sector. This model explains the deterioration of India's trade balance, with the merchandise deficit reaching $311.2 billion for the current fiscal year. While exports have seen a slight contraction, the oil import bill drove a 24. This massive dollar outflow has pushed the rupee to a record low of 92.5 per USD. To manage this volatility, the RBI has drawn down forex reserves to $710 billion. And while foreign investment flows have improved recently, they are not enough to bridge the structural gap created by energy imports. This dependence is compounded by a struggle in India's core sectors. While steel and cement are growing, domestic crude and gas contracted by 5%. This shrinking domestic output makes the country even more reliant on the shipping lanes that are currently closed. Overall industrial growth is currently holding steady at 4%, but that figure is being undercut by the contraction in hydrocarbons. This pressure is visible in the logistics network, where the rising cost of diesel is increasing the cost of moving goods. The only factor currently preventing a balance of payments crisis is the $200 billion surplus generated by the service trade. Long-term progress in non-fossil power, now at 52% of capacity, is a vital buffer, but it cannot replace liquid fuels in the immediate term. The external sector is acting as a drain on the Indian economy, siphoning off the capital generated by the domestic boom. The final transmission of this shock is appearing in consumer prices. The wholesale price index is at an 11-month high, and CPI inflation has climbed to 3.2%. These figures are driven by food inflation and a surge in the price of gold and silver, placing direct pressure on household purchasing power. Globally, the risk of stagflation is rising. GDP growth estimates for 2026 have been downgraded to 2.9% as inflation reaccelerates. Traditional monetary policy is hitting its limit. Higher interest rates cannot solve the physical blockage of a global trade artery. With essential energy infrastructure requiring multi-year repairs, the current market represents a systemic reset of global costs. If oil prices remain at these levels, the momentum of India's domestic economy will inevitably grind to a halt as inflation eats into real wages. The Strait of Hormuz has become the world's most expensive choke point, imposing a cost on every sector of the global economy. In March 2026, the physical reality of geography has reasserted its dominance over financial markets. Geography is destiny, and Hormuz is the wall.